Welcome back to the deep dive. We are doing something a little different today.
Yeah, this is a fun one.
Usually we take a stack of articles on a trending topic or maybe a new best-selling book, but today we're tackling a
The
beast.
beast is a good word for it.
We are looking at the actual architecture of the financial world. We are peeling back the layers on how money is managed, how markets are analyzed, and arguably how the modern economy is graded and assessed.
It really is the architecture. We're diving into Volume 2 of the Canadian Securities Course textbook. And I know that sounds dry on the surface. Textbook doesn't usually scream excitement, but this specific volume is essentially the gatekeeper.
Right. For those of you listening who aren't in the industry, the CSE, the Canadian Securities Course, is the barrier to entry. If you want to sit in the advisor's chair, if you want to manage a portfolio, or even if you just want to sell mutual funds in a regulated environment in Canada, you have to get through this text. It's the baseline of competence.
Exactly. And what's fascinating about Volume 2 specifically is the shift in focus. Volume 1 is very much what are the products. It defines stocks, bonds, derivatives, mutual funds. It's the vocabulary.
It's the what?
It's the what. But Volume 2 is how do you use them.
Yeah.
It's the transition from knowing what a hammer and a saw are to actually learning how to build a house that doesn't collapse in a storm.
And that is our mission today. We aren't here to memorize definitions for an exam. We're here to decode the toolkit. We want to understand how the pros look at a chaotic, noisy market and try to impose some kind of order on it.
It's a huge task.
It is. We're going to move from the 30,000-foot view, the macro economy, all the way down to the specific accounting ratios of a single company, and finally how you stitch that all together into a portfolio.
It's a journey from the macro to the micro and then to the structural. We're going to tackle the great philosophical divide between fundamental and technical analysis, which is really a battle of ideologies. Then we'll look at how to read a company's report card. And we'll finish with the actual management process, how to mix assets to manage risk.
I'm actually excited to try and make math and charts exciting because it's not really about the numbers, is it? It's about spotting patterns and, I guess, avoiding disasters.
That's a huge part of it. It's about risk management more than anything else.
So let's start with that philosophical divide, the two tribes. It feels like in finance, you usually fall into one of two camps regarding how you view value. You rarely see someone who is perfectly balanced between them.
It is a bit of a holy war.
Mm.
On one side, you have the fundamental analysts, on the other, the technical analysts. And they are looking at the exact same market, the exact same data feeds, but they are seeing two completely different realities.
So let's strip it down. The fundamentalist, this is the classic, perhaps more academic view. This is the Warren Buffett school of thought, correct?
In a nutshell, yes. The fundamentalist is looking for the cause of price movement. They are obsessed with a concept called intrinsic value. They believe that a company has a true, real-world value based on its cash flow, its tangible assets, the economic environment it operates in, and the quality of its management team.
So to use an analogy, they look at a house and they calculate the cost of the lumber, the value of the land, the quality of the neighborhood schools, the condition of the roof.
All of it.
They come up with a number, say, $500,000. If the market is selling that house for $400,000, they say, the market is wrong, I'm buying.
Precisely. That is the core tenet. If the market price is lower than the intrinsic value, you buy. If it's higher, you sell or you short it. The fundamentalist believes that eventually, and eventually is the key word here, the market will wake up, realize its mistake, and the price will rise to meet the intrinsic value.
They're betting on rationality winning out in the end,
They're betting on the convergence of price and value.
which requires a lot of patience. You could be right about the value, but the market could stay wrong for a long, long time. As the famous saying goes, the market can remain irrational longer than you can remain solvent.
That is the nightmare of the fundamentalist. That's what keeps them up at night. Now, flip the coin. You have the technical analyst, the technician,
The chartist.
the chartist. They don't care about the lumber. They don't care about the roofs. They don't really care about the value in that traditional sense at all.
This is the person with 6 monitors looking for shapes in the squiggly lines.
Right. And their philosophy is summed up in 3 key phrases. Price discounts everything. Prices move in trends. And history repeats itself.
Okay, let's unpack. Price discounts everything. That's a bold claim. It basically means that everything the fundamentalist is worrying about, the earnings report, the GDP data, the new product launch, the CEO's health, is already reflected in the current price.
Exactly. The technician says, why spend 100 hours analyzing the balance sheet? The people who did analyze the balance sheet, the hedge funds, the insiders, the institutional giants, have already bought or sold based on that info.
So their actions are already baked in.
Their knowledge is already baked into the price. So instead of studying the cause, the earnings, they study the effect, the price movement itself. It's the ultimate shortcut, if you believe in it.
So if the fundamentalist is an accountant or an economist, the technician is a psychologist.
That's it. That's the perfect analogy. They are studying human behavior.
Yeah.
They're studying the psychology of the crowd, greed and fear. They believe that human psychology is constant. It doesn't evolve.
So a panic is a panic.
A panic in 1929 looks the same on a chart as a panic in 2020. The context changes. Maybe it's a dust bowl versus a virus, but the human reaction is identical. The dump of shares, the spike in volume, the rush for the exit, it creates a visual pattern.
And because humans are predictable in groups, the patterns repeat.
Correct. And if you can spot the pattern early, you can profit from it without ever needing to know why it's happening. You don't need the story, just the shape.
Before we get into the specific tools these tribes use, we have to address the theory that threatens both of them. It's the elephant in the room of modern finance, the efficient market hypothesis, the EMH.
The wet blanket of financial theory.
It really is. Because if the EMH is 100% true, then everyone we're talking about is wasting their time. If the market is perfectly efficient, there is no undervalued stock for the fundamentalist to find.
And no predictable patterns for the technician to exploit. They're both out of a job.
So what does it actually say?
At its core, the efficient market hypothesis states that stock prices reflect all available information. Therefore, the current price is always the best estimate of value. It implies you cannot consistently beat the market because the market is essentially a global supercomputer that processes every scrap of information instantly.
I always found the levels of this theory interesting. It's not just efficient or not. The CSC breaks it down into 3 forms.
Right. And it's a spectrum of belief. You have the weak form, which is the least controversial. It says past market information price and volume is already reflected in the current price.
So looking at a chart of yesterday's prices is useless for predicting tomorrow's.
According to this theory, yes. If weak form is true, technical analysis is useless. Looking at a chart of the past tells you nothing about the future because any pattern that existed has already been exploited and erased by people trading on it.
The semi-strong form. This is where it gets harder for the average investor.
This says all public information is priced in. News, earnings reports, economic data, dividend announcements. If this is true, fundamental analysis is largely useless for the average person.
So me reading a company's annual report can't give me an edge.
Not according to this. The theory says you can't read a financial statement and find an edge because thousands of high-speed algorithms have already read it and adjusted the price before you even open the PDF.
And finally, the strong form, the most extreme version.
The most extreme. It says all information, even private insider information, is priced in. This suggests that even if the CEO knows the company is collapsing tomorrow and hasn't told anyone, the market somehow intrinsically knows. The price already reflects it.
That seems demonstrably false.
It does.
I mean, given that insider trading laws exist and insiders do make money when they trade illegally, if the market already knew what they knew, their trades wouldn't be profitable.
Exactly. Most practitioners agree the market isn't strong form efficient. The real debate, the billion-dollar question, is whether it's semi-strong efficient.
Because if it is, then the only logical thing to do is buy a low-cost index fund.
Precisely. But if you believe markets are inefficient, that they overreact to bad news or ignore good news for a while, then you believe you can find an edge. And that's where the toolkit comes in. You are essentially betting that you can find the flaw in the EMH.
So let's assume for the rest of this deep dive that we can find an edge. Let's put on our fundamentalist hat first. It seems like the CSC suggests a top-down approach. You don't start by picking a stock, you start by looking at the world.
Always start with the tide before you look at the boat, the macro. You have to understand the environment the companies are swimming in. And the big 3 factors here are fiscal policy, monetary policy, and inflation.
Fiscal policy. This is the government. This is the budget.
It's the government's use of spending and taxation to influence the economy. It's a blunt instrument, but a powerful one. If the government cuts taxes, consumers have more cash, businesses have higher margins, and generally stocks go up.
Or they could ramp up spending.
Right. If they launch a massive infrastructure project, say building high-speed rail across the corridor, that pumps money into the system. It creates jobs, it buys concrete, it buys steel. That is expansionary fiscal policy.
But it's slow, right? You don't change tax codes overnight.
Glacial. Passing a budget takes months. Implementing it takes longer. The impact is huge, but the lag time is significant. It's like turning a giant tanker ship.
Contrast that with monetary policy. This is the domain of the Bank of Canada.
The speedboat compared to the government's tanker. The central bank can change the economic landscape in a single Wednesday morning announcement. Their mandate is simple, at least on paper. Keep inflation low and stable and preserve the value of the Canadian dollar.
And their weapon of choice is the interest rate.
The overnight rate. Think of interest rates as the gravity of the financial world. When rates are low, gravity is weak, money flows easily, asset prices float up, borrowing is cheap, businesses expand.
The party is on.
The party is on. But when rates rise, gravity increases, everything gets heavier. It costs more to service debt, so corporate profits go down. It costs more to get a mortgage, so housing cools. The central bank is essentially the person who takes away the punch bowl just as the party gets going.
And this brings us to the yield curve. The text highlights tilting the yield curve as a critical signal. I think a lot of people hear yield curve and their eyes glaze over, but it's actually one of the most reliable crystal balls we have in finance.
It is. It's shockingly predictive. The yield curve simply plots the interest rates of bonds from short-term, like 3 months, to long-term, like 30 years. In a healthy, growing economy, the curve slopes up.
Which makes intuitive sense.
It does.
Yeah.
You get paid more interest for locking your money up for 30 years than for 3 months. That's logical. You are taking more risk with time, so you demand a higher term premium.
Right. If I lend you money for 30 years, a lot can go wrong. Inflation could spike. You could go broke. I want a higher rate.
Exactly. But when the central bank is trying to kill inflation, they jack up short-term rates. They slam on the brakes. Short-term yields shoot up. But, and here's the key, if investors think that hiking rates will cause a recession, they expect rates to be cut in the future to fix that recession. So long-term yields stay low or even drop.
And the curve inverts. Short-term rates are higher than long-term rates.
That is the flashing red light. An inverted yield curve has predicted almost every recession in the last 50 years. It's the bond market saying, the party is over. We expect the economy to break, and we expect the Bank of Canada to have to cut rates to fix it. It's a vote of no confidence in the near-term economy.
So we analyze the macro, we see where the rates are going. Next, we look at the industry. Because a rising tide lifts all boats, but a storm sinks some faster than others.
Industry analysis is about understanding the life cycle. Industries are like biological organisms. They're born, they grow, they mature, and eventually they decline. And the strategy for investing in them changes completely based on the stage.
So let's walk through the impact of that on an investor. What does each stage feel like?
Okay, so if you invest in the emerging growth phase, think early AI right now, or the internet in 1995, you are buying a lottery ticket. These companies are usually unprofitable. They burn cash.
They're all about the story, the dream.
Exactly. The risk is massive. Most will fail. But if you pick the winner, the payoff is exponential. You're looking for that one that survives and dominates.
And you have growth?
The industry is established. The winners are starting to emerge. Sales and earnings are growing faster than the rest of the economy. This is where the big compounding happens. But competition starts to heat up. It becomes a land grab for market share.
And after that, maturity.
The cash cows. Think of Coca-Cola, banks, or major utilities. They aren't going to double in size next year. They grow with the GDP. But they're stable, predictable, and they spit out cash in the form of dividends. You buy these for income and safety.
And finally, decline. The buggy whip manufacturers.
Or video rental stores. Or newspapers, maybe. Technology shifts. Tastes change. The fundamental analyst has to identify which stage an industry is in. You don't want to value a declining company as if it's a growth company. That's how you lose your shirt, thinking a stock is cheap when it's actually just dying.
The text also mentions Porter's 5 forces here. This is classic business school stuff. But how does an investor actually use it?
It's a checklist for how easy is it to make money in this business. It helps you find companies with a trainable competitive advantage, or what Buffett calls a moat.
So let's use the airline example you mentioned earlier. How would that work?
Okay, so force 1, threat of new entry. For airlines, it's high. You need billions for planes, gates, regulatory approval. So the barrier to entry is pretty strong.
That's good for the existing players.
It is. But then, force 2, rivalry among existing competitors. It's brutal. Airlines compete almost entirely on price. It's a race to the bottom on margins.
Okay, bad for them.
Then you have threat of substitutes. Can you take a train?
Yeah.
A bus? Drive? Yes. So there are alternatives.
Mm.
Then bargaining power of buyers. That's us, the travelers.
And our power is huge.
It's immense.
Ugh.
We just click the cheapest ticket on Expedia or Google Flights. We have very little brand loyalty. And finally, bargaining power is suppliers. Think Boeing and Airbus, they're only two. Or the pilots' unions, they have a lot of power.
So when you add it all up,
It's a tough industry to maintain high profit margins in. It's a grinder. An investor uses Porter's model to see if the company has a moat around it that protects its profits, or if it's in a knife fight every single day.
and finally, we classify industries by how they react to the economy. Cyclical versus defensive.
Crucial distinction. Cyclical industries, autos, lumber, luxury goods, move with the economy. If people feel rich, they buy cars. If they feel poor, they fix the old one. Their earnings are volatile. Defensive industries, utilities, grocery stores, healthcare are stable. Even in a recession, you need to eat and heat your house. Your investment strategy should probably include some of both.
Okay, so we've analyzed the world, we've analyzed the industry. Now we have to pick the specific company. This is where we get into the weeds of the financial statements. The report card.
We're going under the hood, and the tool we use is ratio analysis, because raw numbers are deceptive. If I tell you company A has $10 million in debt, is that bad?
Depends. Do they have $100 million in cash or $1 million in cash?
Exactly. Or do they have $1 billion in revenue or $5 million? Ratios give us context. We compare them against the company's own history, the trend, and against its competitors, the external benchmark.
The book groups them into 4 buckets: liquidity, risk, operating performance, and value. So let's hit the highlights. Liquidity. This is, can we survive the night?
It's about solvency. The current ratio is the standard. Current assets divided by current liabilities. Can you pay off your short-term debts with your short-term assets? You generally want a ratio of 2 to 1. You want a buffer.
But the text brings up the acid test, the quick ratio. Why the scary name?
This is the skeptical analyst's ratio. It calculates the same thing but strips out inventory. Why? Because if you go bankrupt or if you need cash today, you can't necessarily sell a warehouse full of unfinished widgets or last season's fashion.
So it's not quick cash.
Not at all. Inventory is the least liquid current asset. The quick ratio asks, if we sold nothing tomorrow, could we still pay our bills? If that ratio is below 1 to 1, you're walking a tightrope.
Then we have the risk ratios, specifically leverage, debt.
Debt to equity. Leverage is a multiplier. It's a double-edged sword. If you borrow money at 5% and invest it to make 10%, you are a genius. You've amplified your return using other people's money. That's positive leverage.
But the sword cuts the other way.
It does. If business slows down and your return drops to 3%, you still owe the bank 5%. Leverage works both ways. High debt to equity means the company is risky, especially if a recession hits and revenues dry up. That debt payment is still due.
Okay, third bucket, operating performance. This tells us how good management is at the day-to-day.
Inventory turnover is a favorite of mine. It tells you how many times a year the company sells out its entire stock.
High is good, right? It means you're selling stuff fast.
Usually. It means you're efficient. You aren't paying to store old stuff. But, and here's the nuance, if it's too high compared to the industry, it might mean you are understocking. You're missing sales because the shelves are empty.
So it's a Goldilocks metric.
Exactly. You want it just right compared to the industry average. Not too hot, not too cold.
And finally, the value ratios. The celebrity of the financial world. The PE ratio.
The price to earnings ratio. It's the price tag on the stock. If a stock has a PE of 20, you're paying $20 for every $1 of profit the company makes.
And this is where the art comes in. A low PE sounds good, it's cheap, but it might be cheap for a reason.
That's the classic value trap.
Yeah.
A company might have a PE of 5, super cheap, but it's because everyone knows their main product is about to become illegal or their patent is expiring. The market is discounting future failure.
And the opposite is true for a high PE.
Right. A tech stock might have a PE of 50. It looks expensive. But if their earnings triple next year, at 50 might actually be a bargain in hindsight. You can't look at PE in a vacuum. You have to look at it alongside growth. It's the PE to growth, or PEG ratio, that gives you a much better picture.
All right, let's pivot. That was a great deep dive into the fundamentalist view dissecting the business logic. Now let's look at the squiggly lines. It's time to talk about the chartists.
The technicians. Let's do it.
We talked about their philosophy. Price is everything. History repeats. Let's talk about the actual patterns they look for. The text highlights the head and shoulders. It sounds like shampoo, but I gather it's a warning sign.
It's the most famous reversal pattern in technical analysis. Visualize a mountain range on a price chart. You have a left shoulder, which is a price peak, then a dip, then the head, which is a higher peak, then another dip, and finally a right shoulder, which is a lower peak.
Okay, I can picture that. What is that actually telling us about the battle between buyers and sellers?
It tells a story of exhaustion. The buyers push the price up to the head, a new high. Everyone's excited. But then selling pressure pushed it down. Then the buyers tried again. They formed the right shoulder. But this is the critical part. They couldn't even reach the previous high. The momentum is gone.
The buying power is fading.
It's fading. The sellers are taking control. When the price breaks the neckline, which is the support level connecting the two lows, the trend is officially dead. It's a very strong sell signal for technicians.
You mentioned support and resistance. These are concepts even casual traders hear about all the time.
They're fundamental to technical analysis. Think of them as psychological barriers in the market. Support is a floor. Let's say a stock falls to $50 and bounces. It falls to $50 again and bounces.
So what's happening at $50?
At $50, the market collectively thinks that's a bargain. Buyers step in. The demand at $50 is stronger than the supply of shares for sale. It forms a floor.
And resistance is the ceiling?
Exactly. The stock hits $100 and drops. People think that's too expensive, or people who bought lower start to take their profits. It creates a ceiling of selling pressure. But here is the magic of technical analysis. If a stock breaks through resistance, if it smashes past $100, that old ceiling often becomes the new floor.
Why is that?
It's pure psychology. People who sold at 100 now regret it, and if the price ever comes back down to 100, they see it as a second chance to buy. And people who missed it the first time see it as a new entry point. The psychology flips.
One of the other big tools mentioned is moving averages. How do they help smooth out the noise?
A moving average does exactly what it says. A 50-day moving average, for example, is just the average closing price of a stock over the last 50 days. It creates a single, smooth line on the chart.
And that helps you see the trend more clearly.
Way more clearly. It filters out the day-to-day volatility. The simple rule for technicians is that you want to own stocks that are trading above their moving average, because that means the recent price is higher than the average price. The trend is up.
And the signals.
The signals are often when the price crosses the moving average. If the price breaks up through its moving average, that's a buy signal. The short-term momentum is turning positive. If it breaks down through the average, that's a sell signal.
One of the most interesting tools mentioned is sentiment indicators, the contrarian view. This feels like the most human element of investing.
It really is. The contrarian is the ultimate cynic. They believe that the crowd is usually wrong at the extremes of emotion.
So when your cab driver is giving you stock tips, or your dentist is day trading meme stocks.
It's time to sell. The logic is brutal but sound. If 90% of investors are bullish, that means they are optimistic. If they are optimistic, they have likely already bought the stock. They are fully invested.
So who is left to buy?
No one. There are no new buyers on the sideline. If there are no new buyers, the price can only go down. All it takes is one person to sell, and there's no one there to soak up the supply.
So extreme optimism is a bearish signal.
And extreme pessimism is a bullish signal. If everyone hates the market, if magazines are publishing the death of equities covers, everyone has sold. There's no selling pressure left. It's the point of maximum opportunity. So John Templeton famously said, "The time of maximum pessimism is the best time to buy."
Okay, we've analyzed the economy, the company, and the charts. We have a basket of ideas. Now, how do we put them together? We need to move into the portfolio approach.
This is where we switch from being a stock picker to a wealth manager. This is chapter 15 of the text, and arguably the most important chapter for real-world success.
And the core concept is diversification, not putting all your eggs in one basket. It sounds simple, but there's a lot of math behind it.
It's the only free lunch in finance. But you have to understand why it works. It's not just about owning lots of things. It's about owning things that don't move together. It comes down to a concept called correlation.
The text uses a great example for this, the bus company and the airline.
It's a perfect illustration. Airline stocks are cyclical, economy good, people fly on vacations, business travel's booming, airline stock goes up, economy bad, people stay home, airline stock crashes.
Okay, that makes sense.
Now look at a discount bus company. Economy bad. People can't afford to fly, so they take the bus to visit grandma. Bus company stock goes up, economy good, people upgrade to planes, bus company stock goes down.
They move in opposite directions.
That is negative correlation. If you hold both in your portfolio, you smooth out the ride. When the airline is crashing, the bus stock is saving you. You reduce your volatility, your risk. without necessarily reducing your long-term return. That's the magic.
But most stocks don't move perfectly opposite like that.
No, of course not.
Right.
Most stocks have some positive correlation. They all vaguely move with the overall market. But the goal is to find assets that aren't perfectly correlated. Maybe you combine tech stocks, which love growth, with utility stocks, which act more like bonds.
Or stocks from different countries.
Exactly. Canadian stocks with U.S. stocks
Yeah.
or emerging markets. The less they move in lockstep, the more diversification benefit you get.
This leads us to the distinction in the book between systematic and non-systematic risk.
This is crucial. Non-systematic risk is the risk specific to one company. The factory burns down. The CEO commits fraud. The drug trial fails.
Things that only affect that one stock.
Right. You can eliminate this risk by diversifying. If you own 50 stocks, one factory fire doesn't really hurt you. It's a blip. You've diversified it away.
But you can't get rid of the other kind.
You can't. Systematic risk. This is market risk. Interest rates spike. A global pandemic shuts down the world. A major war breaks out. A recession. This hits everything.
It's the tidal wave.
It's the tidal wave. You can't diversify away from a tidal wave. That is the risk you are paid to take. That is why stocks return more than bank accounts in the long run, because you are accepting the risk of the tidal wave.
We also need to define alpha and beta. You hear these thrown around on financial news constantly. Let's start with beta.
Beta is a measure of that systematic risk we just talked about. It measures a stock or a portfolio's volatility relative to the market. The market, by definition, has a beta of 1.
So if a stock has a beta of 1.5,
it is 50% more volatile than the market. If the market goes up 10%, that stock should go up 15%. But if the market goes down 10%, the stock is expected to go down 15%. It magnifies the market's moves.
so a high beta portfolio is an aggressive one.
Very. And a low beta portfolio, less than 1, is more defensive. Now, alpha is the holy grail. Alpha is the return you get above what your beta predicts. It's the measure of a manager's skill.
How so?
Well, if your portfolio had a beta of 1.2 and the market went up 10%, you should have made 12%. But if you actually made 14%, that extra 2% is your alpha. It means you picked the right stocks or timed the market correctly. It's the value you added.
Speaking of managers, the text outlines different styles. Let's start with the big one, active versus passive.
Passive is the if you can't beat 'em, join 'em approach. It's a direct response to the efficient market hypothesis. You buy the index, you accept the market return.
And it's big advantage.
It's cheap, it's tax efficient, and statistically it beats most active managers over the long run simply because their fees are so much lower.
But for those who want to try to beat the market, the active managers.
You have a few main styles. You have growth managers. They buy high PE stocks with strong earnings momentum. They're looking for the next Amazon, the next NVIDIA. They don't mind paying a high price if the growth is there. Their mantra is buy high, sell higher.
And on the other side, value managers.
The bargain hunters.
Yeah.
They are the disciples of Benjamin Graham and Warren Buffett. They look for unloved stocks. Low PE, high dividends, maybe the company's in a boring industry or had some bad news. They are contrarians. Their mantra is buy low and wait.
And sector rotation.
That's a top-down approach. You aren't as focused on individual companies as you are on the economic cycle. You make big bets on entire industries.
So you're saying
The recession is coming. I need to sell the banks, which are cyclical, and buy the grocery stores, which are defensive. Then the recovery is starting. I should sell the grocery stores and buy the tech stocks to capture the upside. You are moving your money to the safe harbors or the open seas, depending on the weather forecast.
Finally, let's look at the process itself, the last part of our journey, the roadmap. The text outlines a 7-step process for portfolio management.
It's a loop. It never ends. This is so important. It's not a set it and forget it event. Your life changes, the market changes, so the portfolio has to adapt.
It starts with step 1, objectives and constraints, the know your client phase.
This is the most important step and has nothing to do with stocks. If you get this wrong, the best stock picking in the world won't save you. You need to define the goal.
And the book lays out 3 primary objectives.
Right. Is it capital preservation? The number one rule is don't lose money. Is it income, pay me cash to live on? Or is it growth, make it big for retirement? You can't have maximum safety and maximum growth. They are opposites. You have to pick a lane.
And the constraints are the reality check.
Time horizon is the big one. If you need this money for a house down payment in 6 months, you have no business being in the stock market, period. The risk of a 20% drop is too high. You need to be in cash or a GIC.
But for a 25-year-old's retirement fund,
Your horizon is 40 years. You should be heavily in stocks to fight inflation and get that long-term growth. Other constraints include liquidity. Do you need access to the cash? Tax, what bracket are you in? And any unique circumstances, like ethical investing, for example.
step 2 is the investment policy statement, or IPS.
The Constitution. It's the roadmap for the portfolio. It writes down the rules of engagement. We will be 60% equity, 40% bonds. No single stock will be more than 5%.
And why is that so important? To write it down.
It prevents emotional decision-making when the market crashes. When there's blood in the streets and your gut is telling you to sell everything, you look at the IPS and say, the rules say we hold. It protects the client from their own worst instincts.
Then step 3, asset mix.
This is a mind-blower for most people. Studies show that the asset mix decision, how much you put in stocks versus bonds versus cash, determines about 90% of your portfolio's return variability.
90%. So it's not about picking the hot stock.
It matters way more than which specific stock you pick. Being in the right asset class at the right time is more important than being in the best stock within that class.
And this is where the equity cycle comes in.
Yes. You have to remember that the stock market usually leads the economic cycle. Stocks will often recover and start a new bull market before a recession is officially over.
So if you wait for the good news to be on the front page,
You've missed the rally. The market bottoms on the worst news when everyone has given up hope. You have to anticipate.
step 4 is security selection, actually picking the investments using all the analysis we talked about. And then we have the ongoing steps: monitor, evaluate, and rebalance. I want to focus on rebalance. It sounds technical, but it's psychologically incredibly hard.
It is the most counterintuitive and yet most powerful discipline in investing. Let's say you start with a simple portfolio,
Yeah.
50% stocks and 50% bonds.
Okay, balanced.
Stocks have a massive year. They go up 30%. Bonds are flat. Now, your portfolio is, say, 60% stocks and 40% bonds because the stocks grew so much. You're out of balance.
So to rebalance.
You have to sell the stocks, the winners,
Yeah.
and use that money to buy more bonds, the losers, to get back to your 50-50 target.
It feels like punishing success. Why would I sell the thing that's going up and buy the thing that's doing nothing?
Exactly. Your brain screams at you not to do it. But it forces you, mechanically, to sell high and buy low. It locks in your gains and resets your risk profile. If you don't rebalance, your portfolio naturally gets riskier and riskier as the stocks grow, right before the inevitable crash. Rebalancing is the discipline that saves you. It forces you to act against your greed.
We have covered a massive amount of ground today. I mean, we've gone from reading the tea leaves of economic policy all the way down to calculating the quick ratio and then to balancing a portfolio like a master chef.
We have. But if there's one takeaway from all of this, from the entire textbook, it's that investing isn't just about guessing which stock will go up tomorrow. It's a process,
A discipline.
a discipline. Whether you are a technician drawing lines on a chart or a fundamentalist reading balance sheets, you need a disciplined framework. The portfolio approach isn't about chasing the highest possible return. It's about managing risk to ensure you meet your life goals.
And here's a final thought to chew on. We started this whole conversation with the efficient market hypothesis, the idea that all info is already in the price. If that is 100% true, then all the analysis we discussed today, fundamental, technical, company ratios, is technically useless for beating the market. You might as well just buy a passive index fund and go to the beach.
Then yeah.
And yet, the world's biggest fortunes, from Buffett to Soros to Jim Simons, are built by people who believe the market is inefficient. They believe they can find the flaw in the system. They believe they can find the value that the market missed or the pattern that others don't see.
It's the great paradox, isn't it?
It is. If everyone believes the market is efficient, nobody does the research. If nobody does the research, the market becomes inefficient.
Exactly. It's the effort of the active managers that, ironically, keeps the market efficient for the passive ones. Their search for alpha is what makes prices fair.
So the question for you, the learner, is, are you a believer in the perfect market, or are you betting on your ability to find the error in the price? Which tribe are you in?
That is the eternal question.
Until the next deep dive, keep your stops tight and your research deep.
Goodbye, everyone.